Welcome to Your Money Momentum, a podcast delivering information on personal financial planning, investing, and wealth management. Hosted by global wealth advisors Tom Kennedy and Kevin M. Curley II, this show will feature market discussions, strategy, and practical advice aimed at building momentum with your money. Learn more and subscribe today at 𝙔𝙤𝙪𝙧.net/podcast. And now, here are certified financial planner professionals, Tom and Kevin.
All right. Welcome, everyone. You're listening to Your Money Momentum podcast. My name is Tom Kennedy, and I have Kevin Curley here, and we are going to do our mid-month podcast. Kevin, what's going on?
Just getting ready for some U.S. Open watching after a very exciting Canadian Open, where a guy made like a 90-foot putt in a fourth playoff hole to win. So hopefully the U.S. Open can do as well as the Canadian did.
Yeah, I don't even want to approach the topic of LIV and the PGA. So let's just jump into it.
I think other people have fully covered that.
Yeah, we'll just jump into the fun stuff. So, central bank roundup. What's going on in the world of the Fed?
Shine those boots. It's time for
Doggy.
Central Bank Roundup.
Well, we've got a Fed meeting tomorrow, and we're expecting, based on the narrative in newspapers, on Twitter, and on TV, that they might not hike rates tomorrow for the first time in 10 meetings or so.
Yeah, it looks like the odds are pricing in that there's what they're calling a pause, but now they're saying if they pause tomorrow, which by the time this airs, it'll be 2 days in the rears, that there's a good chance that they're going to hike in July, which is just
I saw it as
crazy.
skip, not a pause.
Skip. Yep, exactly. That's what they're calling it. A skip is the new term they're coining, as we're not gonna move. I think a lot of the numbers are going to be this Friday when you have a lot of the manufacturing numbers come out, a lot of the data to see if how quickly growth is slowing as well. If growth is really starting to fall off, then we could be in trouble.
Yeah, right now we're experiencing disinflation. For those not familiar with that lingo, it just means that inflation used to be at 8%, now it's at 5%. And so it's not deflation because it's still increasing prices. They're just increasing at a much slower rate. And so this morning we got CPI numbers, said the month over month was 0.1%, which is good. That puts you at an annualized rate of just 1.2, which is great. But the core CPI number, so the biggest portion of that is shelter, still over 5%, 5.3 for today's number. So if I'm the Fed, I'm happy that these rate rises did decrease from, we'll call it 8-9% down to 4 or 5, but I'm not done with my job. So a skip or a pause, I think, is premature, and they've suggested that there will be at least 2 more hikes before they were to actually stop. And the markets are still pricing in 2 quarter-point cuts before the end of the year. We're at the midpoint now. It'll be odd over the next 12 weeks for them to take 1 more hike, then wait another 6 weeks, 18 weeks, and then to cut at the end of the year. I just don't know if cutting's in the cards, at least in 2023.
We're in this phase right now where you have the best economist in the world. No one has any idea what's going on. One economist was calling for a 50 basis point hike tomorrow. I mean, some are calling for 1% cut by the end of the year. So it's all over the place, and the market is pricing in and is adjusting almost on a daily basis. So it'll be interesting to see what happens with if it's a skip or a true pause.
What do you think the impact is if they skip, pause, keep raising?
If they raise, the market's already has priced in my opinion, a pause and cuts by the end of the year. So any more hikes this year, you're going to get all those gains that we've enjoyed over the last couple months. I think you'll give right back within a couple days. I think that'll shock the market. I don't think a skip's the worst thing, but I hope this is a pause and we're good.
Yeah, when I've looked back, what I've seen is typically when they start to raise rates, the stock market does continue to do well, goes up. It's when they do pause and stop is when you kind of go, okay, maybe the economy is actually slowing down because they're not making money any tighter. And then the last part is typically when they start cutting rates, that's when we're actually in trouble. And so if we do cut rates before the end of the year, it means that they probably won the fight against inflation, got it below 2, but they killed the economy in the process, and we're now experiencing negative economic growth in the form of a recession or worse.
Yep, I agree. Well, let's jump over to headlines.
Leaving no stone unturned, it's time for headlines and the news you may have missed.
Let's talk about the banks. Banks earning $80 billion net revenue despite this so-called crisis. What are your thoughts there?
What do you think about that? I mean, you're just printing net interest income as other banks are failing and falling apart. I mean, these profits, they're up 33% in the first quarter. There were some one-off gains that helped as well, but the industry widely is just not failing. It's just doing just fine. Their problems seem to be specific to a few banks. It's not widespread. It's not a 2008 type situation. It's a few were poorly managed and got hit, and they're gone now. I would say loan growth is declining, so I think there's a shelf life to this increasing net interest income. But for the moment, J.P. Morgan, some of these other ones, just printing money.
Yeah, it's like we've said before, it wasn't a solvency issue ever. It was a liquidity issue. So I don't think the banks are healthy, and you're looking at the numbers. To your point, JP Morgan, 52% jump in Q1 profits. Wells Fargo did $5 billion in Q1 in the bottom line. And especially the bigger banks. I mean, the bigger banks were direct beneficiaries of depositors, leaving the smaller regionals and going to, the big four, if you will. So,
Yeah, and look, for J.P. Morgan, this is a time where their investment bank's not doing nearly as much business as they used to be doing. And so to have this net interest income is really nice for them, because otherwise you got big problems of we don't have any interest income, we don't have any fee income, we're not making any money. So banks are making money.
Yep.
All right. Well, we know all about the recent, we'll call it CHIP Act, some of the, we'll call it trade war stuff, limiting technology and semiconductors to China. But recently, the British American Tobacco CEO had to have an abrupt departure from his job because they were secretly selling cigarettes to North Korea. There was a big fine for the company. It was $635 million penalty. I think it was estimated for, I don't know if it was $4 billion of cigarettes. I don't know how you figure out what cigarettes are actually worth, but they had violated the law enough times that they got caught supporting the embassy and other things like that. So a very weird one. Smuggling cigarettes is just not something I thought would be a big deal. I wouldn't even think it's a thing that happens. It's very bizarre. But
it sounds like an episode of Sopranos and cigarettes falling off the back of a truck. I don't know if they're smuggling cigarettes. I mean, I can't imagine everything else that they're smuggling over there.
Well, they said the reason they got caught is they got caught smuggling $30 million worth of cigarettes through North Korea's Singapore embassy. And then they found like another $250 million of, we'll call it, cash transfers that they didn't necessarily find the cigarettes. They didn't find them, the smoking gun, whatever else. They didn't catch them red-handed, whatever term you want to use. But $635 million penalty is pretty severe. If we're going to do that, and I say we as, Western countries that impose sanctions on cigarettes, which, look, they have value. I mean, there's something to it. I mean, if you're North Korean, you like to smoke, it's, I guess, pretty valuable. But what I would be curious to know is if certain countries that pass on technology like semiconductors or AI technology or robotics, other things that are currently now being not allowed to places like China, North Korea, etc., if we're going to fine people $635 million for $30 million of cigarettes, what are the fines? What are the penalties if you start doing high tech?
Yeah, that's a good question. I mean, those are massive fines, and there's got to be something else behind that. By the way, that just doesn't sound right. 30 million cigarettes and that big of a fine. I don't know. It sounds a little suspect to me.
Yeah, like I said, they caught him on one thing, but obviously they go, there's smoke a lot of these other places. We've almost got you here, but all right, let's move on. So we got some Merger Mania, not just Live and PGA. It was announced there'll be a $10 billion merger between two lithium miners. Australia's Allkem and U.S. rival Livent struck a deal to consolidate. What's your general take on mergers and why they happen, and what's your take here?
I mean, mergers happen for a couple of reasons. One is there's a bigger company acquiring a smaller company for pennies on the dollar due to poor management, stock price, whatever it may be, or two, because they feel that they can grow the top line, decrease expenses, which is, at the end of the day, increases the bottom line. And if you look at this merger that took place, I think I read that they're going to add 125 million to the top line and 200 million in savings just by merging. They're going to save on capex, and they're going to help speed up the projects. And that's just typical in mergers and acquisitions. And I think you're going to see more consolidation. I think there's a lot of companies that have just over leveraged themselves, and with rates as high as they are, you're seeing it a lot in specific industries and sectors. And I think it's going to be a continued trend going forward.
Yeah, specific to this one, I think you're right about the overall of why you do it. Electrical vehicles have been a huge demand driver for lithium and a lot of different other rare earths. But this merger will be 7% of the world's lithium output. And so I think exactly nail on the head of increasing scale is the key here. So you got to be bigger to survive. And a lot of these materials are really owned by countries. So Chile, for example, I think copper mining as well as lithium mining, et cetera, it's really owned at the highest level in terms of government. So having Western countries allowing companies to do this stuff, to have 7% of the market's great, but they got to achieve that scale in order to be competitive with some of the, I guess we'll call them government-owned, government-sponsored entities.
Yeah, nope, I agree. Well, let's move on to something or nothing. Fed bank bailouts. You're dubbing it as the double secret QE. Fed has been backstopping banks by taking their government bonds out of par. Is this something or nothing?
I think this is a big something, because to me this is quantitative easing, but secretly. So they, I guess, let me let me explain the phrase you just said. So one of the challenges with Silicon Valley Bank is they owned a lot of long-term U.S. government bonds, and so they bought them. We'll just use simple numbers, for $100, and they were suddenly worth $70 when interest rates moved up. What the Fed has started to do at some of these banks is buy back those government-issued bonds for 100, even though if they were going to sell it to you or I or another institution, it would trade around 70 today. And so what they're doing is basically bailing out those banks and fixing their balance sheets and backstopping the problem before it becomes worse. So this isn't a situation where private sector loans that they made are going bad or commercial real estate issues. This is pure balance sheet stuff. And they're going, what if we increased your balance sheet by 30% by just swapping out old bonds for new bonds? And now you don't have those unrealized losses on your balance sheet anymore. So I think it's definitely something.
Yeah, I agree with you. I think why they're doing it is because they feel if they can correct a few of the bad apples now, they'll hopefully fix the bigger overarching issue, which is bonds getting killed and the collateral was there is worth half of what it used to be. But you're right, it's a secret QE bailout. I like that.
Yeah, I think the money's tight at the highest level for the Fed. We can see that with rates rises and the other things they're doing. But underneath there, they're regulating a lot of these banks, and they're saying, we're going to fix this problem before it gets out of hand.
Yep, I agree. All right, let's talk about inflation overseas. So policymakers in Europe are using price controls to try and combat inflation. You got prices up across the board with necessities, sugar, cheese, eggs, potatoes, bread, etc. Is this something or nothing?
This is definitely something. And I think the something is how to address inflation if you're a government, either elected official or bureaucrat, and people are upset that they go to the grocery store and their sugar is 50% more, or their eggs and cheese and their potatoes are 20 to 25% more than they were a year ago. I mean, a loaf of bread is now 16% more. So, I don't think that price controls work. I think anytime you get government intervention like this, it leads to unintended outcomes. And usually what happens with inflation is now they're going to go to their unions and say, we got to raise rates. And then it just kind of keeps growing on itself. So I don't think that this is a solution to inflation. I think the real solution is they can increase the supply of sugar. They can increase the supply of milk, increase the supply of eggs, and some of that's easier said than done. But if you plant a little more grain, you can have a lot more bread.
Well, they're targeting the wrong group, which is the retailers. And if they're capping the retailers are saying, well, I'm still getting at wholesale prices for this, and I have to sell it below what I'm getting it at wholesale. So I'm actually losing money on this. And what you're starting to see is they're going to start limiting what you can buy or stop carrying certain things in their store, because why are you going to have a net loss in your books? If the government were to step in and subsidize those losses, then that makes sense, capping it. But leaving it up to the end retailers to take it, I think, to your point, you said it best, it's going to have unintended consequences.
Yep, they're accountable to somebody, and that somebody is us, and we're upset about the higher prices. So trying to do something, but if you look back at the Great Depression, those price controls it didn't work. And anyway, let's move on to Toss-Up, our next little game. So Tom, I got a quick question for you. Better proxy for market stress, the VIX, which we've talked about on several episodes, or volume?
I would say I would take that in twofold. I would say for the everyday investor, I would say the VIX, because typically there's a good correlation. When the VIX is up, the market's down, and people who watch their 401ks or their investments in general feel the pain. So I think there's more emotions involved. On the other side, for traders, I think it's volume. A lack of volume is a lack of breadth, and that's not typically good. And it's hard to make money in that environment. Versus when there's high volume, you have high volatility, but there's more opportunity. But I think they're one and the same anyway. So that's a tough one. But what are your thoughts?
I've been looking at the VIX for a while, and I've been using that as the kind of indicator for market stress. But once I kind of thought about this, and from the person who made the comment, I think volume is the simpler answer. And to see real stress, you can see March of 2020, you can go back to 2008, and it's a really easy chart. You can do it, monthly using technical analysis, and you just see the bars start jumping. And because you use color coding, the green ones are good, red ones are bad. And you see, wow, these red ones, it lines up really well. And so I think, if you looked at leading up to the debt ceiling stuff, the VIX was complacent, volume was low. They tend to say the same thing. I think it might be just a little bit easier to say, how much volume is there? Okay, now we're in some stress. Versus the VIX, it's a little more mathematical. It's not as simple as, well, you got to divide by 2 or 1.6, and then that gives you this anticipated move per day. Volume's like, is there a lot of volume? Yeah, okay, it must be a stressful time.
Yeah, no, that's a good point. I think there's outliers too. When you see those big spikes in volume, it's more apparent. So let's move on to the next one. U.S. cities experiencing the donut effect. Commercial business districts struggling, while the rings of the outer urban and suburban areas are thriving. So, question is, downtown or the burbs?
I'm a suburbs guy. Now I like a close suburb, so I don't want to be too far away from the city. But downtown's tough. It got a lot of action, a lot going on. It's hard to walk down. There's one-way streets going each direction. There's people you probably don't want to run into. You get out to the suburbs, you got a little space to stretch your arms out, go for a walk with your dog. There's nice, white picket fences as a joke, but nice green manicured lawns. Things a little bit cleaner. So for me, suburbs are the way to go.
Yeah, and I think it's a real issue. I mean, we're seeing it on the commercial side for office buildings, and now with everyone having the option to go into work or work from home, they're leaving the cities, and I think the main reason is the commute, the cost of it or the lack thereof in some cases. I mean, give you an example. When I used to live in New Jersey and I had to commute to New York, I mean, it was an hour door to door. It was extremely expensive. I was paying double the taxes. It was not efficient. And I think you're seeing that with areas like San Francisco and New York, which New York's got the subway. And I think you're seeing people go out to the outer burbs like Long Island and New Jersey. With that said, I'm going city because I'm a city guy, and I think you can find some opportunity right now. In fact,
city guy
actually,
hard, huh?
I was talking to a buddy who's in commercial real estate, and they're thinking there's some corporations that are thinking about converting office space to residential because they just don't think they're ever going to come back. So that should be interesting to see how that plays out.
Yeah, I like that idea. It's, from what I understand, really expensive to convert, but I think there's a lot of value in a place like New York where it's already expensive. The capex on the project can make a lot of sense. So I don't know how many people want to live in a skyscraper in downtown Dallas or downtown Houston, but we'll see. All right, should we go put on your, I guess, get your crystal ball and put on your hat and see Nostra-Thomas?
Let's go. I'm ready.
And now, we ask our soothsayer to gaze into his crystal ball. Let's hear from the alchemist himself, Nostra-Thomas.
All right, Nostra-Thomas, thanks for joining us today. The Fed has raised rates a lot. However, the longest they've ever held, we'll quote, high rates was in 2007. It only lasted for 9 months. How long will the Fed keep rates high this time around?
Yeah, so if you go back to that last tightening cycle, I think it started in 2003, early 2004. They raised rates, Greenspan, a quarter basis point, 0.25% every quarter for 17 quarters in a row. And then they paused when they got to 5.5%. And Bernanke, the only reason why he lowered rates is because we went through the Great Recession. So I don't think there was this, hey, we're going to keep it there for 6 or 9 months. They kept it there until something really broke, which was the global housing market. Unfortunately, I think the same may be true this time around. I don't think they're going to, they've already gone this far. I don't think they're going to backpedal and say we need to drop rates. And the minute that they do bring rates down, I think that is a very bad signal that something really broke in the market. So I think they're going to hold longer than usual this time around. And it wouldn't surprise me that, we're at the same. Let me put it this way. I don't think we're going to cut this time. We're going to cut this year unless something really terrible happens in the economy and you see a massive recession take hold and we have this hard landing.
All right, we'll see if they can break the 9-month, we'll call it world record. All right, thank you, Nostra-Thomas, for that answer. Our next question is, the G7 in 2000 had over 40% of global GDP. Now it's down to only 30% as China, India, and other countries have grown. The US dollar and the euro still dominate global currency reserves. Can the G7 dominate the future, or has a huge shift taken place?
Well, in regards to currencies, and for those who are unaware, the G7 is made up of the US, UK, Germany, Italy, Canada, France, and Japan. I would say a close third and fourth for currency is the yen and British pound. So those four currencies have pretty much dominated the world currency. And you look at China and India and that big jump of global GDP going from 40 to 30%. I think, and I don't know the stats, but I would assume that 90% of that 10% gap probably is off of China and India alone. I mean, those economies are growing and they're expected to grow. But I don't think that there's going to be a shift in currency because one, the G7 and the US and the UK and those areas represent some of the biggest economic centers in the world. And there's something called the rule of law, which you don't really have in certain areas like China. And then also in international trade. I mean, you look at the dollar, 60% of all transactions in the world are done in the US currency. Half of global debt and loans out there are based in US dollars. And the central banks have 60% of their reserves sitting in dollars. So the only thing that breaks and bucks that trend is if people start losing faith in the U.S. Economy. And if we continue with our debt and we get downgraded, that could possibly change.
Yeah, I think that's a great answer. Thank you, Nostra-Thomas. All right, our final question for Nostra-Thomas is, there's a new hot casual lunch in Japan. It is a soup made of salmon and fresh milk clam chowder. It's called Zelda soup, and it comes from the Nintendo game named Zelda. Apparently, it's a really popular game still. I remember it I think in N64 or 30 years ago, 20 years ago, but I guess it's still very popular in Japan to the point where people are going and ordering Zelda soup. So, Nostra-Thomas, I guess, have you ever had Zelda soup? And if so, or if not, what other great dishes are we going to get from video games or wider pop culture? What are you looking to try?
Honestly, I don't know where you read or find this stuff.
This one was in the Financial Times. It's in the opinion section.
That's no, I know you're not making it up. I believe you. Disclosure, I didn't play very many video games at all as a kid, maybe Super Mario Brothers, so I don't know what Zelda is or what the soup is. I have not had it. The best way I can answer this question, I think you've seen the biggest shift I've seen over the last 10 years in just the food industry is the farm to table. And that was done a while ago. I haven't seen anything really since then as far as just big culture shift, at least here in the US. What I am seeing a little bit of is more family style and more of people going out and just ordering appetizers and drinks and not sitting down for your typical full-on meal. But as far as video games go, I wouldn't even know where to start on that one.
Yeah, I think this stuff definitely exists in parties. So you get a shaped cake that looks like something from Mario Brothers or from Zelda or one of these other games. I think that that kind of stuff will always have a space as far as the theme, but I have not seen any of that stuff in the U.S. yet, and I know the Japanese love it.
The Japanese are weird, man. They're into the anime and all that. I hope nobody broadcasts this in Japan, man. I love them.
How about they have a unique culture that's different from our own? How about that's a nice way to say it.
No, but they're also weird. And by the way, some of the best cuisine I've ever had is in Japan, and it's not sushi. That was obviously phenomenal, but it was a steak. It was the hibachi. They have some of the best food ever in Japan. So if I'm going to Japan again, it's not to eat Zelda soup. I can assure you that. All right. Well, that was a good one to finish up on.
Thank you, Nostra-Thomas. We'll see you next time.
All right. Well, we'll leave it off there, and we'll be back in a couple weeks with our month end.
All right. Thanks, Tom.
You've been listening to Your Money Momentum, brought to you by Global Wealth Advisors. To learn more about GWA and its talented roster of financial professionals, head on over to 𝙔𝙤𝙕 Thanks, and we'll see you next time on Your Money Momentum. All indices are unmanaged and investors cannot invest directly into an index. Certain sections of this commentary contain forward-looking statements that are based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties, which are difficult to predict. Past performance is not indicative of future results. Diversification does not assure profit or protect against loss in declining markets.